AI.
The AI.
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 Right now, AI is exploding. Companies like Nvidia are hitting trillion-dollar valuations, becoming more valuable than Amazon, Google, even Tesla. Why though? Because AI is about to reshape the entire economy. By 2030, it's set to inject over 15 trillion into global markets. Jobs are disappearing, automation's everywhere, and this is just the beginning. So naturally, everyone wants in. But what's the first thing they all jump into? Well, starting an AI agency. Sell chatbots to local businesses, build automation systems, promise the world and cross your fingers. But here's the brutal reality that nobody really admits. Almost every single AI agency is doomed to fail. They're stuck chasing bad clients, wasting thousands on tech they barely understand. And honestly, most of these agencies aren't even using AI the right way. Building an AI business right now isn't smart. It's slow, expensive, and already oversaturated. Instead, the people who will really cash in on AI aren't running agencies, building chatbots, or managing clients. They're investing in the AI sector. So in this video, I'm going to show you exactly why starting an AI agency in 2025 is a big mistake, why becoming an AI investor is the real way to win, and how you can start doing it today, even if you're completely new and starting from scratch. So let's get into it. So let's talk about the current wave of AI side hustles, because yeah, AI is the future, but not all opportunities are created equally. And most of the popular advice out there, it's just not the best way to actually benefit from this boom over the long term. Let me show you what I mean. First, the AI agency model. You cold email local businesses, offer to automate their ads or customer service with AI tools and charge them a monthly retainer. It sounds great in theory. You're packaging AI into a service and selling it to people who don't really understand it. But here's the problem. Most small businesses don't even know what they need. You spend more time educating them than closing them. And when they do sign, your profit margin disappears into fulfillment headaches. You become a glorified freelancer with a fancy AI label. And worst of all, you're not really leveraging AI, you're just using it as a buzzword. Then there's the build a chatbot trend. Use tools like ChatGPT to build chatbots for real estate agents, dentists, e-com brands, charge a setup fee, maybe a small monthly retainer. But again, the issue isn't the tech, the issue is the demand. Most businesses don't trust AI to replace human interaction. And the ones that do, they want a perfect, fully custom system, not a plug and play script. So you either spend hours debugging or your client churns in 3 weeks. Either way, it's not really scalable. You're using AI, but you're still trading time for money. But another one is building your own AI tool or app. And look, this is cool if you're a developer or if you've raised money. But for 99% of people watching this video, you really do not need to spend 6 months building something just to pray it gets to users. This idea that you can just build something with AI and get rich is not only wrong, it's also completely backwards, because AI should make you faster, not slow you down with some huge project that may or may not work. So if you're not building tools and you're not running an AI agency, how should you be thinking about this AI wave? What's the smarter, faster, more realistic way to leverage AI, especially if you're not technical? Well, this is where the concept of being an AI investor comes in. And no, I'm not talking about dropshipping or affiliate marketing or something that requires you to be a tech nerd. This is something much more powerful and way more future-proof. Let me explain. The answer is actually really simple. Don't build with AI, leverage it. Sell pickaxes to those mining for gold. Look, when most people think about investing, they picture boring portfolios taking 10 to 20 years to make meaningful returns. But that's not what we're talking about. I'm talking about making money every month by leveraging the AI wave. The best way to do so in 2025 is by being an AI investor and not a traditional investor. I'm saying invest in the AI wave itself and make money through established players in the space like Nvidia. Because if you want money now, traditional investing is bad for a bunch of reasons. So traditional investing, in my definition, is probably what a financial advisor would tell you to do. Nice and slow, steady returns. But at the end of the day, do we just want slow and steady returns? No, we do actually want outperformance. But IFAs love to collect fees. They love to ensure that, you're not losing money, but you're not making too much, because at the end of the day, their benchmark is very, very flat. If they start really outperforming and then they have a bad year, you're going to ask, oh, why did you perform this year but not so good this year? They want a smooth equity curve. What we want as individual investors is more money in our SIP, ISA or investment account at the end of the year, and you do not get that by being boring. IFAs also have a 5-year time horizon, and again, remember, I'm using the example of IFA here in the traditional investor sense because it makes most sense to do so. I actually wrote an article for This Is Money, which is part of the Daily Mail, on exactly this just a couple of weeks ago, because the problem with having a 5-year time horizon is that you miss out on all of this outperformance in the shorter run. And by shorter run, I'm not talking about day trading here. I'm not even talking about holding trades for a week or a month. I'm talking about relatively mid-term views on the market through which companies like Nvidia will really, really benefit. We're talking 3, 6, 12 months, but not the 5-year time horizon that IFAs would love for you to invest in. The other issue with a lot of traditional investing, especially via IFAs or via certain funds, is that they do have redemption periods. So your money might be locked up for a fair amount of time to prevent withdrawals or mass withdrawals or runs on the fund, for instance. Because at the end of the day, these guys are fee generators. If you have a shorter time horizon and you're willing to be nimble with the right strategies, risk management and trade management, then that is what we're looking for as individual investors. We don't really have to focus that much on things like Sharpe ratios or Sortino ratios, because at the end of the day, we do not mind taking on more risk when we know that we should do. We don't have to be so fixed in our risk-adjusted return profile. So how do we do this then? We focus over this time period on the hottest sector, which is AI. This is where you can effectively leverage a component of the market called beta. This is where these AI stocks will outperform a benchmark like the S&P 500. And with adequate risk management, you're able to buy that outperformance and effectively get out before it starts ticking down again. This is what we're referring to when we're talking about riding the AI wave. Since there's so much money flowing into the AI sector as well, related chips, graphics card, everything to do with AI, more money flowing in equals more opportunity. So in one sentence, what are we doing here? Well, we are running with the AI bubble. Now, there's a really famous investor, George Soros, and he said that bubbles are for buying, and I completely agree. People complain about bubbles all the time, but the problem with those complaining about bubbles is that they keep watching price go up and up and up. They keep calling it a bubble and they make zero money. You should not care if something is in a bubble or if your perception of something is in a bubble. Your job is to extract capital from the market, and you're able to extract capital during a perceived bubble by having good risk management. That is exactly how we do things at the Academy. We want to run with that outperformance. Now, if we take an example of this outperformance, Nvidia last year did 171%. Now, yes, it's more volatile than the S&P 500. However, it is now a massive, massive component of the S&P 500. So if you saw our Trump video from the other week, you will know that when a stock gets that big, there is some forced buying that goes on. As it's a component of the S&P 500, Nvidia will almost always be a stock that gets first bought if the market dips. So you can use this to your advantage now, because if you know that Nvidia is such an integral part of US wealth and of the S&P 500 passive complex, ETFs and things like that, then you know that there is a margin of safety by being invested in Nvidia. It's not just an AI stock here, it's integral to the entire fabric of US capital markets. Because AI stocks really do outperform in this environment, what we're we're able to do is use the strategies that we teach in the academy to really focus in when they have the right conditions showing on AI stocks. Now, this might mean that we're focused on, okay, interest rates might be coming down, or our growth model, which we show you, is indicating the right time to buy an AI stock like Nvidia, ASML, or others. And with this, you're able to really focus in on the trend, and all we care about at the Think Academy is up and to the right. All we care about at the Think Academy is that line going as quickly up and to the right and as hard up and to the right as possible, because that is how you make money as an individual investor. You don't make money trading these silly sideways ranges that loads of people might tell you to do. You just want stuff that is going up in price for as long as possible. Make your life easy. Now, I'll be honest with you, I actually these days process most of my orders by my phone. You don't actually need that much when you're looking at the longer term picture to actually get involved with investing. Unlike day trading, where you might need a few screens because you're focused on a load of different asset classes, different products, and different news feeds coming through because you're terrified about the market going against you in any tiny way. With what we do, we're focused on, okay, we can buy something this week and we can wait and check it a week or two later. You do not need to be looking at stuff all the time, mainly because we don't use a hell of a lot of leverage, but also we understand that our system is going to give us signals over that longer period. It's not going to give us signals hour to hour. You do not have to sit and be anxious anymore. So how do you get started doing this? Well, if you're in the US, you will have to use a US broker dealer. But if you're in the UK or the EU, you can come and chat to me. We've got a select few partners that we can introduce you to. It does depend on what kind of account you want. If you want a standard investment account, that's fine, we can cater to that. If you want an ISA account or a SIP account, we can cater to that as well. And we can also help you and guide you on how to actually systemize your discretion. We don't want you looking at social media for the next big cue as to when you want to go and buy something. We want you to understand why you're buying something, when you should buy something, and what to buy. We're not telling you what to buy though, we're just providing you with a lovely framework which will reduce that anxiety and enable you to take a skill of a lifetime away. So we use something called the 1-4-10 method. We're looking at one country, which is the United States of America. We're looking at 4 moving averages, which are a slight indicator as to where the trend is, and we are looking at stocks with a market cap of over $10 billion only. Why do we focus on that? Well, there's less liquidity risk. There's far less counterparty risk, i.e. the company is unlikely to go bust overnight. And we also understand that if a stock has a market cap of $10 billion, it's likely that it's existed for a fairly long time. So we can understand the trend from a much longer time period. We want you to systemize your discretion. No more gambling, more investing. So I've mentioned a few times throughout this video the importance of risk management, trade management, and things like that. A couple of things that newbies tend to go wrong on is firstly getting way too emotional with regards to where they put their capital. But this over emotion comes from the fact that there is no system in place. It doesn't come from the fact that, you're not excited about something. I get excited about stuff when my system shows something popping off. A stock has just provided a brand new signal after, 12 months. And the last time it provided that signal, we made 20-30%. I still get excited. Emotion isn't a bad thing, but emotion has to be contained within a systemized framework. You should be getting excited because you understand that this signal has a higher probability, whereas before you might have been getting excited because you've just seen loads of people talking about it on social media. By the time loads of other people are talking about it, the signal has actually gone and you're not going to make any money, most of the time anyway. The other factor is that people tend to overcomplicate analysis. Look, you do not need 10 different factors to determine if the market is going to go either up or down. What you require is the ability to understand a handful of things that loosely tend to make money in the market over time that are repeatable. This is what we go through in the academy to really drill out any kind of bad habits or bad mistakes that you've been making over your time. We focus on trend. We focus on the understanding of mean reversion. We focus on the fact that we can systemize our risk management to ensure that we're extracting that beta, extracting that outperformance of a benchmark of these individual stocks. These things are absolutely vital to building that structure, building that system that stops you from gambling. Listen, I think jumping on the AI wave absolutely makes perfect sense, but you've got to do it in a systemized way. You can't just be going and jumping on any old stock, because capital flows to maybe the 20%. If you're picking the 80% of rubbish, you're not going to go anywhere. Come and check out the Think Academy, because what we're going to allow you to do is finally have the freedom from anxiety, because you understand why you're approaching the market each day. You understand how you're going to compose your ISA, your SIP, or your investment account, and you will take away the key element of risk management that will be able to allow you to free up your time, and so you're not staring at your computer and phone 24/7. Click the link below and check us out.